we have already analyzed the types of charts. For most traders, candlesticks are considered to be the most effective way to read the markets. In this episode, we will explain in depth what it's all about and some very common mistakes beginners do. A rice merchant came up with this genius idea about the 18th century in Osaka. Back then, we had no way to know the prices every minute and use all these fancy tools we have today. They were introduced to the Western world by Stephen Ninson in the book Japanese Candlestick Charting Techniques, first published in 1991. Traders were not surprised, as the price action idea was not new. Slowly the technique grew in popularity in the 90s and 2000s. So what are Japanese candlesticks? Well, the idea is very simple. They can be used in any time frame. In simple words, we can see the open prices, the close prices, the high prices, and the low prices of the entity we choose to trade. We have already explained why a simple line chart is not enough. Based on the open and closing prices, we have several patterns that can be formed. These patterns will be explained in this episode. Close above open, a white candlestick is drawn. Uptrend for the period. Close price below open, a black candle is drawn. Downtrend for the period. The part of the candle filled is the body. The lines above and below are also called shadows. These shadows represents the highest and the lowest prices for the given period. As we progress, we will notice several types of body shapes in candles. Some long bodies indicate a trend for the period, either short or long, if the prices keep closing higher or lower. The longer the body, the more intense the price action for the given period. When the bodies are short, we have the opposite, low buying or selling pressure. We might also notice some candles with no body at all. Yes, don't worry, we will see everything here. This means the open prices and the close prices were the same or almost the same. This is a sign of indecision in the market. Neither bulls or bears took over control. Now we said about black and white candles. The colors can be adjusted in all of the platforms you will trade. A small tip at this point is try to make the colors neutral. As we have already suggested, a simple white and black might be the best solution. Intense colors might affect your psychology when looking at the chart. Based on the body of the candle, we have seen bulls or bears taking over the market. As we explained, a big long body indicates that for the period there was a big buying or selling pressure. Later on, we will see how you can combine this information with several candles to help you with your trading decisions. Another important part of a candle's body is the shadow. These shadows are the prices for the given period. The upper shadow is the highest price and the lower shadow is the lowest price. Well, you might think, why on earth this information is important? Well, let's give an example, even though we will see much later advanced patterns. Let's say you have several candles with full body in a direction, up or down. At some point, you see a candle with huge shadow. So the market has reacted at these levels. This means that a reversal might be coming. Of course, we will explain later on in this episode some common mistakes beginners do as they try to analyze the market only by using candlestick patterns. Candlesticks with long shadows shows the trading action occurred past the open and close prices. Short shadows indicates that most of the trading actions was confirmed near the open and the close. Indecision in the market. Based on the shadows of a candle, we can understand the market. If the upper shadow is longer than the lower shadow, buyers were stronger for the period. However, they didn't manage to prevail. The opposite is when we have longer, lower shadows. In any of these cases, neither buyers or sellers manage to prevail. The open price of the candle and the close price of the candle will be in a short range. Shadows several times are more important than the body itself, especially when we might have an upcoming reversal in the market. The moment you were waiting, let's see what are the candlestick patterns and how we can use them in our trading. You will also find a video in the description below with all candlestick patterns. The basic categories are two: simple candle patterns that consist of one candle and advanced candlestick patterns that consist of more than one. You will learn spinning tops, morning stars and evening stars without any stars in the sky, dragonflies that are not bags, marabozu, dojis and so on. The lingo is not important at this level. Again, I am suggesting the video in the description that all patterns are explained. Even though it's very boring, at least you will get the idea. Spinning tops, Japanese candlestick with a long upper shadow, long lower shadow and small bodies are called spinning tops. Whether you are in an up or a downtrend, the idea is the same. As we explained earlier, this shows indecision in the market. A small body indicates that there was no big difference in the open and close price. Neither buyers nor sellers could gain the upper hand, and the result for the period was a small change in the price. Now, let's see why and when this is important. If a spinning top forms during an uptrend, this means that aren't many buyers left, and a possible reversal might be coming. If a spinning top forms during a downtrend, is the opposite. A market fell at this point, but sellers were not able to prevail. Marubozu is the first important candle you will see. Marubozu is the Japanese word and means closed cropped head, bold heel. Is the name of a candlestick formation used for technical analysis to indicate a stock has traded strongly in one direction, a full body candle. Now remember what we said. Do not expect the prices to be perfect. Tiny shadows are expected. Perfect candle patterns are very rare. You need to understand how candlesticks work and not each candle individually. The mechanism of how candles can reveal future prices is the one we need to understand. So, no shadows or very small shadows for the period. A theoretical Marubozu is a full body candle. When it's white, the open price is the same with a lower price and the closing price is the same with a higher price. The opposite when we have a black one. Usually we use them as a confirmation signals that the trend is starting. In your trading methods you need to use several confirmation before entering a market. If a white Marubozu forms at the end of an uptrend, we expect the market to move higher. If it forms at the end of a downtrend, a reversal is likely. The opposite principles when we have a black Marubozu. Dojis are candles with no body at all. Doji candlesticks have the same open and close price. Now remember what we said. Do not expect to be perfect. Doji candles suggest indecision in the market. Prices move above and below the open price during the session, but close at a very near to the open price. Neither buyers nor sellers were able to gain control. There are several special types of doji candlestick. Dragonfly doji, hammer doji, star doji, bearish, bullish, long leg doji, and gravestone. When a doji forms on your chart, pay special attention to previous candlesticks. As an example, if a doji forms after a series of candlesticks with full bodies, it might be a signal that buyers are becoming exhausted and weakening. The opposite in a downtrend. Look for a white candlestick to close above the long black candlesticks. In the next following episode, we will take a look at specific Japanese candlestick patterns and what they are telling us. Now let's start with single candlestick patterns. These patterns are the strongest and might suggest major reversal in the market. Hanging man and hammer. The hammer and hanging man, they look the same but different meaning. Both have small bodies but long shadows in one direction. The hammer is a bullish reversal pattern that forms during a downtrend. It is named because the market is hammering out a bottom. When the price is falling, hammer signals that the bottom is near and the prices will start rising again. The long lower shadow indicates that seller pushed prices lower, but buyers were able to overcome this selling pressure and close near the open. Remember what we said, we do not trade these patterns individually. Long shadow, little or no upper shadow, the real body is at the upper end of the trading range. The color of the real body is not important. The hanging man is a bearish reversal pattern that can also mark a top of a strong resistance level. Indicates that the market will change direction. When the price is rising, the formation of a hanging man indicates that sellers are beginning to prevail. The long lower shadow indicates that seller pushed prices lower during the session. Buyers were able to push the prices back up, but only near the open. The hanging man stands with the same principles. A long lower shadow, little or no upper shadow, the real body is at the upper end of the trading range. The color of the body is not important, though a black body is more bearish than a white. Inverted hammer and shooting star. As traders, you won't searching the night sky for stars, but you will try to identify them in your chart. The inverted hammer and shooting star also look identical. The only difference between them is if you are in a downtrend or an uptrend. A shooting star is a bearish reversal candlestick. An inverted hammer is a bullish reversal candlestick. Both candlesticks have very small bodies, long upper shadows, and small or absent lower shadows. Again, remember what we said. Do not expect to see the perfect candles formation. Inverted hammer. The inverted hammer occurs when the prices have been falling, suggesting the possibility of a reversal. Its long upper shadow shows that buyers tried to beat the price higher. However, sellers prevailed. Buyers were not strong enough to close above the opening. Since the sellers weren't able to close the price any lower, this is a good indication that everybody who wants to sell has already sold. And if there are no more sellers left, we have the buyers. Shooting star. The shooting star is a bearish reversal pattern that looks identical to the inverted hammer, but occurs when the prices has been rising. Its shape indicates that the price is open and its low, but pulled back to the bottom again. This means that buyer attempted to push the price up, but sellers came and prevailed. This is a definite bearish sign, since there are no more buyers left, because they have been all overpowered. Advancing in more complex patterns, we have the dual candlestick pattern. This consists of two candles. Two is always better than one. There are two types of engulfing candles, bullish engulfing and bearish engulfing. The bullish engulfing pattern is a two candlestick reversal pattern that signals a strong up move may occur. Both engulfing candles at any market direction means that either buyers or sellers are exhausted at this point. The bullish one happens when a bearish candle is immediately followed by a large bullish candle. This second candle is the confirmation candle of the pattern. This means that buyers are getting ready to jump into the market. The bearish engulfing pattern is the opposite. This type of candlestick patterns occurs when the bullish candle is immediately followed by a bearish candle that completely covers it. This means that sellers took over and will continue from now on. Another type is tweezer bottoms and tops, and these are the strongest one. Tweezer candlestick patterns are two reversal patterns. This type of candlestick pattern is usually spotted after an exhausted uptrend or downtrend, indicating that a reversal will soon occur. There are two types of tweezer patterns, the tweezer bottom and tweezer top. The most effective tweezers have the following characteristic. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is opposite the overall trend. They look identical. The shadows of the candlesticks should be equal. Unfortunately, this is in theory. We are expecting to be at least equal. Tweezer tops should have the same highs, while tweezer bottoms should have the same lows. This pattern shows huge rejections in these price areas and potential market reversals. Goes without saying, 3 are better than 2. Going further in our analysis, we have the 3 candlestick patterns. These patterns are reversal patterns which signal the end of the current trend and the start of a new trend in the opposite direction. Remember and keep notes, it doesn't mean that the market will necessarily reverse. We will also check other 3 candlestick patterns are continuation patterns which signal a continuation of the current trend. As traders, you won't search for signs or stars in the sky. Evening and morning star are the most iconic patterns. The morning star and the evening star are triple candlestick patterns that you can usually find at the end of a trend. They are reversal patterns that can be recognized through 3 characteristics. We need 3 candles to verify them. The first candle is a bullish candle as part of the uptrend. The second one has a small body with shadow. It's not important if it's a bullish or a bearish at this point. The third candlestick is our confirmation that a reversal is in place. The last candle needs to close above the middle one. The information makes sense if we analyze how buyers and sellers acted. Whether we are on an uptrend or a downtrend, buyers or sellers are exhausted. The middle candle indicates that the market doesn't close lower or higher. The prices will start to reverse. The third candle is a confirmation. Indeed, the opposite side has taken the control. Now keep notes. Evening and morning star are more powerful when the market shoots up or down very fast. 90% of the times when the market spikes at an abnormal rate, most likely will return to normal prices again. 3 white soldiers and black crowds. From my experience, the most misunderstood pattern. The pattern is very simple. To identify the 3 white soldiers, look for 3 consecutive green or white candles. Each must close higher than the previous one. The candlesticks should have big bodies and very small shadows. The 3 white soldiers are indication that the market is making a move after a consolidation in an area, for example. The first of the 3 soldiers is called the reversal candle. It either ends the downtrend or the period of consolidation. The pattern is valid when you have 3 candles with big bodies. We need either the candles to be identical or proportionally bigger. The 3 black crowds is just the opposite. The same principles also applies here. 3 candles with small shadows. This is an indication that the reversal is coming in the opposite direction. 3 inside up and down. The 3 inside up is a formation that indicates that the downtrend is over and the uptrend has started. To validate the pattern, the first candle should be at the bottom of the downtrend and it's a long bearish candlestick. The second candle should be at least at the midpoint of the first one. The third candle needs to close above the first candle's high. The idea is now the sellers are exhausted and in the same rate buyers has taken the control. The opposite when we have the 3 inside down. The main idea behind these patterns is that the market will start reversing following the previous structure. We will see in future episodes a more complex analysis, but for the moment we need to stick to the basics. Remember what we said, candlesticks are useless on their own. We need to learn to combine the information. Most people, when they hear about advanced trading patterns, believe that some fancy formations will help them. Well, it is a tool, no doubt. In this series, we will check everything available out there. A good example of how to apply what you learn is in support and resistance levels. You will find the video in the description below. A strong rejection in the previous supports or resistance, combined with a candlestick formation we described, might be a signal to enter the market. Now put a trend following indicator in your recipe. Yeah, I know you like it. We will see also how to combine indicators, but hold your horses for the moment. The entire idea of candlesticks is to understand deeper the market behavior. Candlestick patterns and more advanced patterns we will see in the future won't be useful if you don't know when to use them. In future episodes, we will see advanced candlestick patterns consisting of several candles, not 1 or 3 or 7, but an undetermined amount of candlesticks. It sounds chaotic. Well, it is. In trading, nothing is written in stone. If you had traded on those candlesticks formation alone, you would have lost every single time. As new traders, this is the most important part. You will do several mistakes. Candlesticks means nothing on their own. You need to combine them with market conditions and use them as signals. You will try to identify every candle. Start searching for things that are not there. This will mislead you and you will be searching for the tree while your entire forest will be on fire. The market will be trending in front of your eyes, but you won't be able to identify and you will searching for candlestick formation. Again, this is normal for new traders. That's why we said you need to start with demo accounts. You will see things that are not there. You will enter a trade just to enter the trade. Combine that with changing time frames and you are completely lost. The more you try to see things, the more your brain will play tricks on you. You stick to useless details and information, like how high or low are the shadows, percentages, and perfect analogies. The market won't respect that. You need to have imagination. This unfortunately is the hardest part, and it will come in time and experience. You are not patient enough. You think that you will lose the market. Wait for the confirmation and the formation as a signal. Entering the market too soon or too late will be a problem. Every time you are trading, you need to set some principles. This is one of the most important parts. Candlesticks are just a practical way to check market prices and market conditions. There is nothing there, no crowds, no soldiers, no stars. The market will follow a chaotic pattern most of the time. Many times the market will reverse once you got out of the trade. Learn to change time frames. Candlesticks won't be able to show you the momentum of the market. While you might notice a full body daily candle, when changing time frames into 1 hour or 5 minutes, you will see completely different things. What time your broker resets the day is also important. You will see different things while using different brokers from different time zones. Practice your imagination, use smaller time frames and try to imagine the biggest picture of the market. For example, how 60 candles of 1 minute each will look into 1 hour chart. This will help you to identify the biggest picture. Practice a lot in small time frames. Use the 1 minute chart. Now make a small test. Write down how many times the formation of the candlesticks were accurate. Repeat the same in the future while you combine with other trading tools and you will be amazed by the progress. Go back, repeat the chapters you are not sure, and trade safe.